Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB this Friday afternoon on what has been an awful day for markets if you are long in these markets. Of course, some big falls coming through in the ASX 200 falling below 8,000 points. So we are at a 6-month low. A 2% drop there on the CBO 200, and what we've seen on the ASX has also really exacerbated in late afternoon trade, closing lower by around 1.8%, 7,950 falling below the 200-day moving average, and really just red across pretty much every sector. A lot going on. We've been following, of course, what's been happening with the tariff latest in the US, and then, of course, we're on cyclone watch as well. Although we are hearing that Brisbane is deceptively calm, though, as we start to see Cyclone Alfred hit the offshore Queensland coast. A 6-month low on the market. Let's have a look at some of the themes of the day. Really just plummeting below that 8,000 point level. Always psychological, these levels, but we did hit that in September, and we've been pretty much holding above and ratcheting higher those levels, and now we've sold off quite significantly, of course, over the month of February and the first few days of March as well. Banks must, because a lot of the weakness has come through from the big banks. When you've got a 3 to 4% drop from index leader CBA, you know it's going to be a tough day out there. And I was talking earlier to John Lockton from Sandstone Insight saying, look, maybe everyone started to pay attention to these broker calls to get out of the banks, which have been there for some time, certainly seeing a lot of weakness coming through from the big four. And crypto crossroads as we await the first crypto summit at the White House. At the same time, the US president earlier today, our time, did announce that Bitcoin strategic reserve, but you have seen some weakness coming through in the actual Bitcoin price because the US will be holding it as an asset, not necessarily allocating. And a really fascinating conversation I had with Joe Shu from crypto earlier, Crypto Insights. You can catch that online, ausbiz.com.au. Getting back to the equity market though, let's have a look at the sectoral moves. As I mentioned, a lot of weakness coming through today. You've got the crypto movement there with Bitcoin below 88,000. But let's also have a look at what we've been seeing in terms of the banks. CBA down almost 4% to $148.50. Also weakness coming through in the tech sector. Kicking it off with what we've seen with some of those players in the tech space. WiseTech Global down almost 4%. Zip, which was the stock of the day on the call today, down 4.2% to $2.04. Also looking at some of the consumer players today, Woolies and Coles did okay. Remember though that they had traded ex-div and dragged a little bit lower, but rebounding today up about 0.5%. Elders also had a good session, up by about 3%. And also having a quick look at what we saw in terms of some of the corporate stories. Rio completing the acquisition of Arcadium Lithium for $10.5 billion. Shares pretty flat. Orica forecasting stronger than expected first half. Still expecting significant items of $300 to $350 million. Shares up by about 1/3%. Insignia was really the outperformer of the day. Continuing here with the ongoing takeover proposals, new non-binding proposals from both Bain and CC Capital at $5 a share each. Polynovo tumbling. It tried to oust its CEO amid reports on bullying. And Car Group down 3%. Citi expecting its North American business to slow down in the first half of this financial year. Also looking at insurers, of course, as we await Cyclone Alfred. Insurance Australia Group down by about 1.7%. Suncorp and QBE on track to lose around 5% and 2.7% respectively over the course of the week. IAG and Suncorp earlier in the week clarifying they did have a proper reinsurance program in place to deal with the effects of the cyclone. And of course, our thoughts with thousands of residents in Australia's east who have been ordered to evacuate ahead of landfall expected on Saturday, with the storm bringing heavy rains, huge waves and strong winds that have really cut off power, eroded beaches and closed airports. All right, let's welcome to the COB now Shane Oliver from AMP. Always good to see you, Shane. Happy Friday.
Thank you.
Although not such a happy one for the equity market. We're below 8,000.
Certainly not a good one for investors. I kind of think this pullback has been coming for a while now. We had thought that this year would be a good one for investors, but nowhere near as good as it was last year. We also thought that at some point along the way you'd get a 15% plus correction, and maybe we're starting to see that. Obviously, Trump's tariffs are the key driver, but there's also issues around the banks being relatively expensive in Australia. But yes, the tariffs there, I mean, that shows the average effective US tariff rate going into the US for imports. You know, we started last century off at close to 30%. We had a nice dip, and then, of course, it took off again through the 1930s with the Smoot-Hawley tariffs, which played a role in the severity of the recession. Now, if the tariffs on steel and aluminium, which kick off next Wednesday, and those on Canada and Mexico ultimately go ahead, of course, some of them have already gone ahead, and you add that together with the Chinese tariffs on China, then you're looking at an average tariff rate going to the US of 11% or so, which is well above where it was back in January at around 3%. So this will cause an impact, and of course there's a lot more to go, and investors are now starting to worry about the impact of that on global growth, on inflation, and on earnings.
Yeah, I love the other chart you provided us too, the US Trade Policy Uncertainty Index, and how much that has spiked in 2025. You can see that right up there, and at, you know, similar levels, but even higher than what we saw in the pandemic. So as you say, this increasing uncertainty weighing on investor sentiment and pushing things lower. But talk us through, in your words, this chart.
Well, what it shows there is trade policy uncertainty. It's sort of gathered or gleaned, if you like, from newspaper articles and references to uncertainty about trade and trade policies, references to things like tariffs and so on, and then you track them over time. We didn't do that, but the organisation referred to down there in the footnote did. And of course, that's where you get the number from. That spike that occurred up until into the pandemic actually got underway in 2018 when the tariffs really started. Initially, I think, on washing machines and solar panels in February of 2018. And so that spike there was quite significant. Ultimately, it contributed to a 20% or so, almost 20% fall in US shares from a high in September 2018 to a low on Christmas Eve 2018. This time around, that tariff uncertainty has gone well beyond the levels under the first Trump administration. And that reflects the fact that we're seeing average tariff levels pushing well beyond, with a lot more to go. Just in the last week, he's been talking about tariffs on agriculture, and Australian agricultural exports swamp to the US, that is, swamp our exports of steel and aluminium. I know we're still sort of focused on that, but steel and aluminium are kind of small relative to our beef exports. I think $800 million of steel and aluminium went to the US last year, whereas $6.1 billion worth of meat went to the US. So, you know, it's hard to see that we'll get out of this completely, even if we do get an exemption on steel and aluminium, which is looking questionable. I think somewhere along the way we'll get affected. Trump will take offence that we prefer to watch AFL and rugby rather than gridiron or whatever it is, and decide to put a reciprocal tariff on us. So that's a high risk, but it's probably not the thing that the market's most worried about. The markets are most worried about a global trade war, less global economic activity, and that causing less demand for our exports.
Yeah, and all of this, of course, coming as we are awaiting news of when our own federal election is going to be called, has to be called by mid-May. What are we seeing with the overall economy and I guess our own living standards in terms of household disposable income and how Aussies are faring ahead of the election?
Well, the good news is that there has been a slight lift in real household disposable income per person over the last 6 months of last year, and that was helped by the tax cuts and wages growth creeping above inflation. And it's the blue line in the chart there. If you get the microscope out, you can see the slight lift. But of course, anyone looking at that chart will see that the blue line has had a big fall from where it was a few years ago, 3 years ago, when it peaked. It's still down about 10%. So if that's a measure of living standards, household real disposable income, then we've still gone backwards. And of course, you can also look at the blue line there and see that it hasn't done much over the last decade. We saw some very strong growth in living standards and household after-tax disposable income through the period in the 1990s, particularly from the mid-90s going into up until about 2010. And since then, it's slowed right down. And of course, that is a big concern. It's why a lot of Australians worry about the cost of living. Their wages simply, their earnings haven't kept up with prices. One of the big factors that you can also see from that chart there is that the deterioration in living standards as measured by households' income after tax, the blue line, also correlates with weakness in productivity growth. We're not growing our output per hour worked as much as we used to. And of course, productivity is a key driver of living standards. And unfortunately, it also has gone pretty much nowhere over the last decade and has had a big slump over the last few years. So this is all a big concern. Ideally, going to the election, try and fix this up. We should be debating ways to improve it. But of course, I don't expect a lot of that because productivity enhancing policies aren't exactly popular and don't exactly win elections.
Well, it's International Women's Day tomorrow, and I read your colleague Diana's great piece there on, what Labor has done under its current terms in trying to improve getting women or retaining women in the workforce. I'm sure you've read it too. You're an ally, Shane. Tell us, I guess, what you're seeing in terms of how we're getting close to are we getting close, I guess, to some kind of equality in the workforce?
Well, we've got a long way to go. You can see it in the wage gap numbers out over the last week. I'm also associated with an index called the Finance Women's Index, which shows that the gap is improving. But we do have a long way to go on some measures in terms of unpaid work, education, the sort of courses that young girls study at university. We've got many, many years, decades potentially, to get to a situation of equality. The government has done things recently. Diana's note did refer to less women concerned about the cost of childcare. So there has been some improvement there with the childcare subsidies. There's still issues around the availability of childcare though. One big improvement, I think, over the last few years has been work from home, but that, of course, is coming under fire as things happen in the US. They gradually keep creeping into Australia. One side politics in Australia is talking about winding that back or eliminating it for federal public servants. The problem with that is that I have no problem with mandates that you should come into the office a couple of days a week or whatever. I think the ideal is a hybrid model in terms of productivity. But if you force 5 days a week on women who don't have as much flexibility as men, often still are lumbered with all the childcare responsibilities, that could push them back out of the workforce. And we have seen over the last few years a big rise in female participation. Diana had the chart there showing a nice rise. If we go backwards and say cuts spending on childcare and more importantly, particularly importantly, cut back on working from home and enforce 5 days a week in the office, that could be a huge retrograde step in giving women that flexibility. So I think there's some things we have to be pretty wary about here. We do have a fair way to go, but we've got to make sure that when we implement policies, we do so in a way which doesn't discriminate against women. And I think if you're mandating 5 days a week in the office, it will discriminate against a lot of women. And that will be a problem as well. We wanted to grow our workforce to get the labour market working well again in Australia. We've managed to do that over the last few years. We've still got very low unemployment. But if we go backwards on working from home, that'll mean less women in the workforce, less economic growth in Australia, a smaller labour force, and ultimately more difficulties in the years ahead as we grapple with the issues of an ageing population, because we'll simply have less participation in the workforce.
Absolutely. Let's hope we don't go backwards. And thank you, as always, for your very insightful comments. And you are proof, Shane, that working from home can be very, very productive. Have a great weekend.
I'm here right now. Look, I started doing this 2002 after my son was born. That's how I started working from home. It was 1 day a week. The technology was available back then. It really became possible from around the year 2000 onwards as the internet improved in speed and so on. And that worked ideally for me. And my productivity went up because as an economist, as an analyst, you need a day to think about things. And I could do that on the day I worked at home, along with picking my kids up from school and doing those sorts of things. So I've sort of been through that. And I think it's something we need to preserve those benefits. And don't go overboard and force people back the other way.
Shane Oliver, is it too late to run for Prime Minister? You've got some...
Possibly is, although, I've got, what's Trump, 78, 79 or something?
Yeah, I'll back you.
I'll back you. Years.
Absolutely. All right, have a fabulous weekend. Thank you as always, Shane.
Okay.
Shane Oliver, AMP Chief Economist. The stock of the day today was Zip. Nadine was joined by June Bailu from 10Cap, Adam Dawes from Shaw & Partners.
Still have very strong sort of growth, and then the update they had early this year, including the result, is that its US business still growing over 40%. Incredible amount of growth, and domestic business is becoming more profitable as they focus on profitability, and then the newer market newer space they go into, is showing very positive green shoots and signs. So the business hasn't changed. What's really changed is essentially all these companies done incredibly well. The tech businesses, the financial businesses in the last 12 months has now been sold off.
You want to be owning these businesses when interest rates are falling, not when they're rising, and this is the right time. I've been doing a lot of work on MoneyMe, all of these not payday lenders, but these other lenders that are out there.
Non-bank lenders, yeah.
Yeah, the non-bank lenders, and they still haven't recovered, but it's probably the right time to be looking at that sector and looking into that as well. I mean, I've always loved Zip. I own it still. Ridiculously high prices, and I've bought every time that they've done a share purchase plan on the way down. I'm happy to stay with the buy.
All right, not many market leaders out there today. Insignia, of course, we touched on, and that is leading the pack as the takeover bids continue. West African Resources often on the board, up 3.5%. Came through with a pretty good update yesterday. Elders looking good, Perpetual and GrainCorp as well. To the downside today, plenty of those. Polynovo, we touched there on, of course, the corporate concerns. Clarity Pharmaceuticals was off by more than 5%. Boss Energy, Ordinate and Capricorn Metals too. In the small end of town, Hutchison had a good day, up by some 14.5%. A lot of resource stocks there as well, bucking the downward trend. And elsewhere to the downside, you had the likes of Amero International and Vinyl, which was off by 9%. It is Friday, it's non-farm payrolls day in the US, so very important figure which will really dictate market action tonight. EU final employment change for the quarter as well, and EU revised GDP. Very interesting to see as well what continues with the move in German bonds, gyrating like it's 1990, not quite 1999 as Mark Todd from Bank of China told me earlier. And of course, looking ahead to the week ahead, we've got a few more ex-div stocks, including the likes of CSL, Westpac Consumer Confidence Index coming through on Tuesday, and on Thursday the CBA Household Spending Insights, given it is the biggest bank in the country. Of course, very interesting to see how households are holding up, how much savings they have and the like, so that will be a good, interesting one to go through. But let's recap on this not so great day where we are, down 2% there on the CBO 200. When it comes to the ASX 200, as we've mentioned, falling below 8,000 points, down 146 points or almost 2% to 7,948. And if we have a look at the losses over the course of the week, down almost, 2 3/4% just in 1 week. So, that is pretty much most of the last 52-week losses happening if you aggregate it in terms of what we saw this week. So a very weak session. Can't really see any bright moves coming through. IT down about 3%, financial stocks off 2.5%. The good news is, though, tomorrow is always a new day with no mistakes in it. We'll see what happens on Wall Street tonight with the non-farm payrolls data, how Wall Street reacts and how that all shapes us up for Monday's action. Have a safe and fabulous weekend. We'll see you Monday from 9:45 a.m. Eastern.